Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr, and I have another really fun show lined up for us today, one that I'm really excited for. And determining and understanding what the primary risk is to your client's investment portfolio, and then trying to successfully hedge that risk is a priority for financial advisors. Well, I have on the perfect guest to address this topic and much, much more. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. All right, let's go ahead and get started and move on to the star of the show. I'd like to give a warm welcome to Brian Jacobs. Brian is the investment strategist at Aptus Capital Advisors. Brian, thank you so much for coming on the show. It's an honor to have you on. Can you just start by telling us a little bit about yourself and Aptus Capital Advisors?
Sure. And first of all, thank you so much for having us on. Really
Mhm.
excited to have this conversation. So I am a strategist, portfolio manager, do wear a number of hats at Aptus Capital, but the firm itself, we also do a number of things within the market and for our clients. On one side, we have an investment management business where we have 9 ETFs, eight of which are options oriented, and we'll probably get into some discussions about options and risk management along the way during this conversation. And then the other half, we do have a financial services business where we partner with advisors on any number of things, including portfolio models, content, trading, any number of things. So we have a very wide business, and we're really excited to kind of share kind of what we do and how we think on this conversation today.
Yeah, it's fantastic. Before these conversations, I always do a little bit of research on the firm, on yourself, and Aptus doing some really great things on the risk management side, and we're going to talk about that. That really opened my eyes up to kind of a different way or different view on risk management that I'm really excited to have that conversation about. Speaking of risk, yeah, a lot of investment managers have different views on risk and what the risk they're trying to mitigate. What investment risk do you think is most important when trying to mitigate it, and you and your firm?
Yeah, I would say there are two main risks that we're really kind of focused on. One is kind of front and center, which is market volatility and drawdowns. And the
Okay.
second is more of a hidden risk that maybe you don't see day to day, but it's the ability of your returns to kind of compound over time and meet your investment needs. And so the first one, it's what you see in the market every day. Everybody's concerned. What did the market do? How much was it down? In the month of April, the drawdown risk, what were portfolios doing in those scenarios? And those are front and center. And we think important for a number of reasons. One, for behavior. We want investors to be able to stick with an investment strategy. And then on the other side, though, the risk of returns not meeting kind of the retirement needs for our clients is very important. And so it's not just about returns being able to meet that, but real returns being able to meet that. And so inflation is a risk in the marketplace that I think a lot of people have kind of revisited the past few years, kind of with the uptick in inflation.
Yeah.
But then even in taxes, the ability for returns to compound over time and after tax be able to meet kind of the investment needs of our clients. I think those two risks, again, one more short term and visual, and then
Yeah.
one more long term and maybe hidden, I think are both as important.
Yeah. It's interesting. I'm really glad you brought up drawdown risk. Risk, investment risk, at Zephyr, we've done a lot of research here, and investment risk has really evolved over the years. When I started agent 20 some years ago, it was all about standard deviation, right? Volatility risk and um, how far does the returns deviate from the mean? And that's great. Everyone really kind of understands standard deviation, but to me, that was a flawed way of measuring risk. And to me, and like you brought it up, the real risk to investing is losing your money and going on the downside. Brian, give me all that upside deviation you want, upside risk, bring that. But it's the drawdown risk. That's what I feel is really the biggest risk when you really talk about that day-to-day visual risk.
Yeah, no, I completely agree. Not even just in visual, but in terms of cash flows. So if you just think about timing of when a client might need those cash flows, if you kind of are compounding and then right when they're about to retire, there's the market drawdown, a
Yeah.
severe market drawdown, it could really change plans. So we are absolutely focused more on kind of the drawdown side of things. That said, I mean, all else equal, you'd rather have something a smoother ride just for everybody.
Yeah.
But if you have that trade-off, yeah, absolutely. We're definitely more focused on drawdown risk than kind of month to month up or down volatility of a percent or two.
Yep. Yep. You brought up inflation. Um, it's funny. Well, it wasn't that long ago. 5 years ago, maybe everyone was talking about inflation is dead. Are we ever going to see like 2.5% inflation? Now it's flipped. Are we ever going to see inflation come back down to 2%? Um, and all of a sudden, that inflation concerns have been stoked again for numerous reasons, whether it's tariffs, the Treasury downgrade, pro-growth policy, you name it. How does inflation risk impact your investment thought process, and then what are some ways financial advisors can hedge against inflation?
Yeah, to us, for when you're talking specific to inflation, it's to us, it's not necessarily a certainty that inflation will happen, but we would probably go on the side of the range of potential outcomes is probably wider than it had been in the past. And
Okay.
so there's the possibility that inflation will be high. There's also a possibility that it could actually come down or maybe be lower than expected. So just in terms of the range of possibilities. And what that means to us is we want to be able to protect against kind of the downside risks of inflation, but be able to participate in the upside should kind of markets do well. One way to do that is to really, again, focus more on longer term, what's the best way to get real return? So irrespective of if inflation's high or low, what are ways in which an investor could capture real return? And so one easy way just to go and kind of go through that it's really more challenging if there's an inflationary environment is to lock in a nominal return over time. And one way to do that is through fixed income. And so right now you could see in rates are moving higher. I think the 30-year just crossed 5% for the first time in close to 20 plus years. If you look at its 20 plus years history, it only crossed 5% a few times. So we're right around that 20-year high level. So that's really attractive from a nominal rate compared to history. But then we start thinking about inflation. If inflation is to tick higher, the 5% goes closer to zero pretty quickly, especially after taxes. And so for us, when you're starting to think about what's the best way to protect, you want to be, in our view, be allocated to something that if there is inflation, that it could capture kind of the embed inflation and grow at a higher rate than inflation over time. And so one way that we think in kind of that is moving away from nominal returns, so moving away from bonds and moving more towards an equity focused portfolio. And then with that, if you just look at that historically, that would be more volatile, larger drawdowns, going back to risk management.
Yeah.
And so for us is can we pair that with other tools to protect against the downside? And so one way to do that would be to hedge with puts on the broader market, for example. Whereas if there is a drawdown, the puts can potentially protect against that drawdown. So to us, it's shifting more towards something that can compound in real return rates and then provide additional incremental protection on the downside. That's what really we're trying to focus on.
Yeah, it's interesting. When I was doing, looking into Aptus, and one thing that really caught my eyes, and you just touched on it, was kind of your thought process, your viewpoint of more stocks, less bonds, right? And I thought that was really interesting. Then we talked about mitigating risk. When I think about mitigating risk or reducing it, you think of incorporating bonds, right? So I feel as if that viewpoint of more stocks, less bonds, and you just brought up, is a little contrarian when you're talking about reducing risk. Can you go into that a little bit more in detail? I know you mentioned, to keep up with, your purchasing power and beating inflation, but there any other thought process there that you can share?
Yeah, we would rather than saying we would say fixed income is a volatility reducer. So
Okay.
if you were to take 100% stocks and then shift it to call it 60/40 traditional portfolio, that portfolio will be lower of volatility. We're pretty confident in that. The question of whether or not bonds themselves will be diversifiers, so uncorrelated to stocks, is a TBD, to be determined whether that's going to actually be the case. In the past, we've seen definitive periods where they've been uncorrelated with each other,
Mhm.
where when stocks are off, bonds are rallying. There's also been periods of past, especially the past 5 years, when stocks are off, bonds are also off. And so going forward, we are not certain about whether the that bonds will protect on kind of the downside.
Yeah.
They will be a volatility kind of dampener. And so for us, it goes to if you're going to allocate more to stocks, less to fixed income. So you're giving up some of that volatility dampening. Are there other ways to kind of mitigate the volatility and to protect the portfolio? And that's really what it all comes down to is when we're looking at a portfolio holistically, is there a better way? And then again, going back to kind of what are the risks in the broader market? Again, shorter term, if there's a severe sell-off in equities and fixed income, even if it's not doing well, it should be lower risk, so less drawdown. But longer term, the ability to again compound and really protect and able to compound returns to meet retirement needs. The more fixed income you have, the bigger that risk. So there is the trade-off at all times between those two risks, between the volatility and the long-term ability to compound.
Yeah, it's interesting. With bonds, and you brought it up with, just volatility and in correlation. During times of crisis and everyone's running to the doors, it's kind of like everything goes down. That's when you need diversification most. And that tends to be when diversification doesn't necessarily work because everyone's running to the exit. But in 2022, we saw that with bonds falling, having their biggest drawdown in history and stocks falling. Um, but you still need bonds, right?
Yeah, we are not of the view that fixed income doesn't make sense in any capacity at all. We do have within our models, this is kind of what we would look at in terms of, okay, what are we actually doing? What are we actually implementing at the portfolio construction level? We absolutely do own fixed income. There are different ways to be exposed to fixed income. You can move shorter duration, for example. Right now, I just recently had a blog post about is there an opportunity, for example, with tips rather than nominal treasuries? And we think that it's pretty interesting kind of space right now. And then there are other tools in terms of creating a return profile that might be similar to traditional fixed income, but might be a little bit more tax efficient. And so again, getting to the ability to compound returns after inflation, after taxes, where it can achieve the long-term needs, but maybe shorter term can look and feel more like the fixed income allocation.
Great. You brought up tips. It's always an interesting asset class. During your research and in that blog, do you think tips should be, one of those mainstays of a fixed income piece of a portfolio? Or is it one of those thematic plays where it's like, okay, I think inflation's gonna uh, have an uptick, include tips? How do you think people should really look at tips?
Yeah, to us, I mean, as a firm, we tend to be more active in nature. Again, we're not active in the sense that we're making changes month to month, but we tend to be opportunistic. And when you're looking at tips, so I mentioned earlier the nominal yield on treasuries north of 5% for the 30 year. When you're looking at tips, we're looking at north of 2.5% real, which means that
Okay.
irrespective of where inflation goes, the investor long term, if they hold the long term, there's volatility in between, is going to roughly capture that real return of 2.5% before taxes. And so, if that's attractive to an investor, and that's assuming a break even of around 2.3% inflation, then that's where it becomes pretty interesting. It's also of the view, if you think 2.3% inflation may be low, then that makes the tips relatively attractive compared to nominal treasury bonds. So again, for us, it goes back to the uncertainty question. We don't know where inflation is going to go, and if there's a lot of inflation, tips will do really well compared to nominal bonds. And if there's deflation, so it underperforms a 2.3% expectation, you are capped on the downside with tips relative to treasuries because of the way that they're structured. You can't, the principal, the dollar amount you put in, it can't, when you at maturity isn't going to go below 100. So for us, if in a world of uncertainty, you're not sure about inflation long term, just from a relative standpoint, we think tips can be pretty attractive compared to nominals.
Yeah. And like you said, speak of uncertainty. We've got a lot of uncertainty out there, especially when it regards to inflation and what might happen. I always feel like it's one of those things. I am a firm believer timing markets and trying to get in and out. It's a loser's game. And with tips like inflation, a lot of times, and markets move quicker than ever. If you think that inflation's going up, you invest in tips, you might have already missed your chance, right? Inflation's already gone up, and tips maybe had their run up. But interesting thoughts on tips.
Yeah, and it's funny. We've had a lot of discussion. So right now, so reason why tips did relatively, or not as well back in 2020, kind of when inflation started picking up, and investors might have been a little disappointed, is because the real return that I mentioned at 2.5% now was actually negative, which means that investors were locking in a negative real return, and when they rise, the price of the tips go down. the question from here is how much higher can that real yield go? Right now, we have a world in which yields are rising, again, over the past few months. If that continues, then you could have potentially, as you point out, potentially a better and more attractive entry point. But again, that's trying to time things. If you think 2.5% is attractive right now compared to nominal treasuries, it might not be a bad time to
Yeah.
kind of shift some over there.
Yeah. Let's talk about options. You mentioned it earlier, strategy that you employ, and a lot of other firms are starting to employ it. I feel as if it's really gotten to be much more popular in, say, the past 5 to 10 years, as using an option overlay to investment strategies. Um, and but you might be able to use it in different ways. And some asset managers might use options to increase income, others may to manage risk within ETFs. What's your view on using options, and what should financial advisors consider when looking at investment strategies that employ options?
Yeah, just as a backdrop, as a firm, we employ them any number of ways. We do have strategies where we use them to hedge equity market risk. We also use them in some strategies to enhance kind of the premium collected, so it's like an income alternative.
Mhm.
So we do utilize them in any number of ways. There's no one size fits all.
Yeah.
The nice thing about options is they are extremely flexible and allow you to kind of put a view on into a structure or into a product or into an overall asset allocation that's pretty custom and unique. Our view on options in terms of kind of how we integrate them is, well, one, we think communication is extremely important. So for investors that are allocating to either our ETFs, our models, or even just are interested in learning more about what we offer or what's out there in the marketplace, getting a really good understanding of what the risks are with options is key. We think there's a lot of benefits, but again, they're not going to work out in all instances. One of the reasons they've become extremely popular the past 5 years is because, in our view, fixed income has not done what investors would have expected. And so, if you're thinking about it at a portfolio level, what's a way to maybe decrease the portfolio volatility or allocate where you're getting exposure to maybe even equities in a differentiated manner that will make it look and feel more like a balanced portfolio? Options have been a new, interesting way to kind of approach it relative to just owning fixed income. So that's one reason it's become very popular. Also, ETFs have more broadly, like with the buffered strategies, which we do not offer buffered strategies, but they've come to fruition and really offer a differentiated kind of return profile in the ETF wrap. A lot of them are very familiar to a lot of investors from kind of more the old insurance kind of world, but in an ETF wrap, it become very interesting. And the last piece, and you see this in a lot of ETFs, is there is a mechanism, if structured correctly, where ETFs holding options can be very tax efficient. And so you see this within a number of the buffer strategies where they might be holding certain positions that traditionally might have been taxed unfavorably, but the return profile, because of the AP process with the creation redemption process of kind of ETFs, are able to create a return stream that is very tax efficient. And so for investors that are interested in this space, it's again learning about how is it going to impact the return profile of their broader allocation and really getting an understanding of the moving pieces so that they are understanding of when it might do well and might not do well.
Yeah, I'm so glad you brought that up, Brian. We're a firm believer, at Zephyr and myself, education is key. Helping financial advisors make more informed investment decisions, but also really knowing what you invest in, right? The vanilla ETF of just going with a spider or VOO, they've got their purpose, they're good, but now you've got all these really intriguing active ETFs that really can play a pivotal role in asset allocation, but you got to understand it, right? So I love that you guys are producing a lot of communication and education about them because it's important to know what you're investing in. It's not a vanilla ETF, but it's very useful in a portfolio.
Absolutely. Yeah, we completely agree with that. And in addition to creating content for our clients and having them sign in and like sign up where we're providing with a lot of information, we also do have a blog with a lot of content in it. So for those that are interested in learning more about that, we could share that at the end of this as well.
For sure. You mentioned tax efficiencies. It's interesting, I don't know why, but I feel as if over the past few years, taxes have become such a major talking point about investing. It should always be, right? You always want to reduce that taxable obligation to Uncle Sam, but it's getting to be a bigger point of investment management. And, you know, for years, and it still is today on the fixed income side, you typically turn the munis. Munis are your number one, most popular, maybe tax strategy for that tax deferred income or tax free income. Are there other fixed income strategies that can help enhance tax efficiencies?
Yeah, absolutely. One of the reasons we think that it's become so popular is for advisors. A lot of them want to streamline their allocations in the sense that they don't necessarily want a completely different allocation in the qualified, so their tax efficient side, and their non-qualified, so their taxable accounts. And as you mentioned, historically, especially within fixed income, so equity ETFs tend to be pretty tax efficient on their
Yeah.
own. So that tends to be the shift from mutual funds to ETFs has been huge for tax efficiency for clients. But fixed income itself, taxable bonds, irrespective of the return year to year, whether they're positive or negative in total return standpoint, the coupon paid out is taxed at the short-term rate. And so just from that alone, that makes them a non-ideal allocation for non-qualified taxable clients. And so they've tended to have within fixed income a taxable allocation to fixed income and a non-taxable allocation to fixed income. The beauty of ETFs structured correctly, utilizing any number of tools, some of them in which case would be options, can potentially decrease the distributable income oriented around those ETFs each year. So if the fund is flat or up, it might have 0% distribution that is taxable in that given year. The benefit of deferring taxes is multifold. One is it could potentially reduce the rate from short term to long term if held more than 12 months. So that's advantage number
Sure.
one. Number two is if there are gains within that strategy, it could potentially be offset with losses elsewhere because it's a capital gain rather than a income-oriented gain. And then the ability just to defer taxes over time is then each year in which you're subsequently holding it, your return is on a higher dollar amount because you didn't pay out taxes on it. And then you're only taxable at the very end when you're selling the ETF. If you could structure something like that within an ETF, it becomes very tax advantaged, especially relative to a taxable bond. And if you and there's a depending on your tax rates, so everything's dependent on this, it could be much more advantage even relative to a muni bond as well because taxable bonds tend to have higher yields than muni bonds. And so, depending on your tax rate, depending on how long you hold it, the end result could be more dollars left in your account within one of these structures relative to even a muni bond within a taxable account. So that's really kind of where we see a lot of the market headed.
Interesting, yeah. And what's nice is those ETFs give you that flexibility, right, to have all these different strategies. Like you said, option overlays, offer some tax efficient strategies within that ETF wrapper. So a lot of great things you guys are doing over there.
Yeah, we're excited about the future for sure.
Yes. Speaking of the future, do you think ETFs, they've exploded. They've exploded in the past year, especially active ETFs. Do you think, we have a longer runway with active ETFs, or do you think we're kind of getting to the point where maybe saturation, there's a lot of crazy ETFs out there. Um,
There are, without naming names, there are a lot of ETFs now that when you start seeing kind of what's put out there from I almost want to mention kind of what types they are, but I don't even want to go there. People are willing to kind of push the envelope a little bit in terms of like what's put out there. In our view, it's like for most investors, you want to be able to create something where if they over allocate to it, they're not going to get hurt too bad. There's a lot of products out there that seemingly, if they get over allocated to, could really negatively impact an investor. But in terms of the grand scheme of things, I mean, we think it's still in its infancy. If you look at the asset base within active mutual funds still. It still dwarfs active ETFs. And from just a structural standpoint, the tax efficiency standpoint, we think it just makes so much more sense for a lot of those products to end up in ETF format. What we are seeing now, it's pretty interesting. We're seeing ETFs as a share class, which is kind of step one. We're seeing a lot of popularity in that as a way for the traditional old guard kind of mutual fund managers kind of getting into the space. And we think it's great. If they can do that and create a product that is similar to their old product, but just be more tax efficient. I mean, it makes a lot of sense for kind of the investors, and we think that'll continue to kind of be a trend on the marketplace. So no, we would say the shift in the growth of ETFs, which is largely thus far, if you look at just percentages, been passive, but increasingly going to active. We think active is going to start increasing a lot going forward.
yeah, I agree. While I think there's spaces in the whether you call it the nine style box, equity style box. and across the board where passive makes some sense. Um, that line is blurring, especially now with active ETFs and the tax efficiencies, low cost compared to active mutual funds. A lot of great things there, but I completely agree. Some of the when they come across my screen, it's like, what in the world is that thing? And I'm all about keep it simple. If I'm a financial advisor, I don't want to wake up with one of those blowing up and trying to explain to your client why you put it in their portfolio.
Yeah, we would tend to agree with that. I think it is one of these things. The marketplace is, as you mentioned, the saturation is real, and so a lot of newer managers probably feel the need, whether it's right or wrong, to create something that's going to kind of stick out and maybe get some headlines. So it is interesting, but we think as a whole that we think the industry has done a really great job.
Yeah, you're right. And like you said, compared to active mutual, there is a big gap still there. One place we talk about fixed income is the fixed income ETFs. I think, when we talk about ETFs, it's a lot of equity ETFs, but I feel like fixed income ETF, there's a lot of room there yet too.
Yeah, and the instance is going back to kind of tax efficiency. The ETF wrap for equities was a game changer in the sense that when transactions were happening within the ETF, they were not taxable. And so just the tax efficiency of active ETFs versus active mutual fund equity funds has been so dramatic. Fixed income was a little bit more challenging initially. If you just think about kind of the tax efficiency of mutual funds and ETFs is largely the same because, as I mentioned earlier, it's the coupon that's taxed, not necessarily the transactions within it. Because the price is not really what's driving kind of the returns, it's the coupon. That's where we think the ETF wrap with with these new kind of innovative structures to potentially defer the income really can be a game changer because that kind of structure could not previously exist within a mutual fund wrap. So that's kind of like if you start talking about ETFs as tax efficient vehicles for equities, that was kind of day one. And we think this new iteration of potential fixed income alternatives could be kind of finally that version of what equity ETFs were in the past.
Yeah. Brian, fantastic conversation. Coming having a Penn State alum on talking to a big Badger fan and being able to be civil about it. Great conversation. You brought a ton of great insight, as expected. It was fun, insightful. Exactly what I thought. You brought up your blog with a lot of great information research. Where can our audience get more information about Aptus Capital Advisors?
Yeah, so Aptus, Aptus capitaladvisors.com, and there's a button at the top called this says blog. If you click that, you could sign up for our blog. You could read the blog post as is, but you could sign up for it that way. Easier way, if you just want to type in Aptus, Aptus space blog on in Google, you'll find your way there too. But if that's a great way to sign up. Put your email in, you'll get emails once a week sent to you with a summary of our blog posts.
Fantastic, Brian. Thank you so much for coming on the show. It was an honor. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel and Spotify. And please be sure to subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your day.